Usually when you introduce a CEO, you want to talk about his company, you want to talk about how great he is, what he did before. Sadly, for Jason and Dave, I want to spend more time talking about Joan and Lori and the team that engages day to day. They say you're only as good as the people you surround yourself with. And I can tell you, I know that about my team. They carry AFC's work. Dave is what it is, obviously, for the work that you've done, but your team is amazing. We love working with them. We love engaging with them. And more importantly, we know that you're going to continue to grow. You guys are changing the way financial services are accessed today and are really been a core member of AFC since you got here just over a year ago. And so with that, I'd love to bring up Jason Wilk, CEO of Dave, moderated by Katy Ryan, partner at Orrick.
Good morning, everybody. I am Katy Ryan. I am a partner in Orrick's DC office and spend my time talking a lot with fintechs. We do life cycle financial services, and that's all I'm really going to tell you about me because we have 25 minutes, and people are really more interested in hearing what you have to say on some of the issues today. So what we're really going to be exploring is how can we expand access while maintaining accountability, right? So how can we get to more customers, but still do it in a safe way that's fair and that's trustworthy? And I think we're very fortunate to have Jason here to sort of talk about how Dave has approached that and to really sort of dig in a little bit about how we prioritize and then how we really think about the regulatory issues that may be out there, whether it's through your day-to-day operations, your bank partnerships, all of those different things. So why don't we go ahead and jump in and maybe start with sort of how you guys have thought about prioritization, some of the challenges you faced, and how did you really decide those challenges were worth kind of pursuing?
Yeah, well, thanks, Katy. Great to be here, and appreciate the shout out, Phil, and thanks for having me. This is a great organization, and appreciate all the helping navigate the pathways for fintech, and especially for Dave. So thanks a lot. So prioritization, I think, comes back to being a real mission-driven company. We set our mission very early on to level the financial playing field on behalf of everyday Americans, and we really think about our business in terms of that. Are we actually providing services that are enabling access for lower income, paycheck-to-paycheck consumers to give them services that higher income folks are used to? That means lowering fees, better access to products, better access to credit, utilizing things like cash flow-based underwriting to democratize credit access. All those things sort of serve our purpose and our mission, which helps us really prioritize. And it's really great to drive a mission-driven company. We had to go through quite a few challenges up and down through our stock price over the last few years, and really proud to say that the vast majority of our team stayed because they weren't there for the money. They're there to really serve our mission and our customers, and it's just really great to see.
Yeah. So kind of sticking maybe just with the customer base. How did you think about, though, the real-world impact to your customers based on what you were building, both in terms of what would benefit your customers as well as, kind of potential downsides?
Yeah, well, I helped drive the early roadmap as I was the target consumer. I was overdrafting my checking account through high school, through college. I knew the pain of a $40 overdraft fee on a cup of coffee or going to buy gas or groceries. It was very frustrating that I'm starting to build my credit score as a young consumer. The bank knows when I get paid. I've been with them for 13 years since I was a teenager, and so why charge me such a high rate for what is a very short duration transaction? And that ultimately led to the founding of Dave, which stands for Dave versus Goliath. We're a little guy going up against the big banks and targeting these largely predatory fees that the banks are charging, which we started out offering actually free credit to consumers. The early version of Dave survived almost solely on tips, where people could give us gratuity if they were enjoying our service, and it was an amazing way to get to market. Ultimately, we've changed our pricing model, which we can get into, but we felt that was very aligned to our customer early on, that what better way to price a product than let the customer choose what's fair to pay, even if that's zero.
Right. So as the regulatory attorney here, anyone tips, we're indirect, but yeah, so I think that's an excellent way to actually even sort of segue into the ideas around bank partnership, right? Because that's been critical to how you guys have scaled. Mm-hmm. And with the regulatory expectations that are changing with respect to your bank partners, what challenges are you seeing there?
Well, I'd say we took a more difficult path early on in our journey, in that we launched the business under a sort of CFPB carve out for earned wage access, and the company was scaling so quickly that we knew that the pathway towards an IPO was sort of becoming a lot more certain. And with that certainty, I wanted to make sure we had a origination model we felt very confident in. And so we decided to go down the bank partnership model, and ended up being a fantastic way for us to scale. We have to have, it slowed us down. I mean, in the sense that every piece of our marketing material gets reviewed, everything that we do with regard to our underwriting gets approved. And so it is certainly a higher bar for fintechs to go do a bank partnership, but ultimately I think did wonders for our business to get us to scale, durability around our pricing model, and also excited about our new bank partnership with Coastal.
And so recognizing that you started early, I mean, for many with bank partnerships, how have you seen it change in terms of how banks are approaching you, and what fintechs should be expecting to have to kind of navigate if they may be looking for or launching new products?
Well, I think the bar has been raised significantly. I mean, if we were to start our company today, I'm not sure we could even start the company. I mean, it's just when we went to do the search for, ran an RFP for our new bank partnership, if Dave was not at scale with millions of customers, had a fantastic compliance and legal department with them, and also the fact that we were profitable, would have been very hard for us to gain the trust of a large-scale banking as a service partner like we have today. And so I think the bar being raised is ultimately good. I think that we want to feel great about our business, and I think the loosening of restrictions to get programs launched, placed a lot more scrutiny on the industry. And ultimately, I think we got to keep the bar high where it is today to keep bad actors out. And ultimately, I think that's going to be beneficial for both banks and for fintechs.
Right. So, but in terms of if you're a newer one, I mean, that we're hearing high bar to entry, right?
Yeah.
So some of the metrics, can you expand a little bit on some of the metrics that they should be focusing in on? I think you've hit on compliance a little.
Well, I think at this point, the ability to manage your own program is going to be key. So legal and compliance, the ability to reconcile your own accounts, the ability to have fast customer response times or resolution times, and ultimately, those are the key things that we look at. And so it's very hard as a new entrant, unless you're bringing on someone that has a lot of experience. Those are things that just take time to learn, and it takes scale to learn, and you have to have real life impact with consumers to get there. And so ultimately, I think that's why it's very hard for new entrants to come in at this point, given the scrutiny of the regulators around new products.
Right. So maybe shifting just a little bit in terms of just a overall approach. So are there times when Dave had to actually choose durability, over speed?
Yeah, I think that goes back to us deciding to become a bank-originated program to begin with, and ultimately getting into banking altogether. When Dave first launched, we were just providing short-term credit access to consumers, as that was the major pain point we were solving for our members. We recognize that most people don't wake up in the morning looking to open up a brand new checking account, but they do wake up with liquidity challenges. And so that's why we started off with the credit product first, giving people access to up to $75 to cover small dollar purchases. Amazing way to get out. But as we wanted to scale those limits, scale our pricing capability, and also launch our most requested feature, which was for Dave to have our own checking account, we obviously had to go to market with a bank partner. And so that did slow us down. It took well over a year to get the program stood up. You have to obviously migrate all your customers over to accounts. And as we're seeing now with our migration to a new bank partner, these things just sort of take time. They're slow moving, and ultimately they're difficult. But as a public company, as a business that wants to be here for the long term, it's sometimes best to take those tougher decisions that make you move slower, but give you a lot more durability in your business.
Right, and likely reduce customer complaints, right? Which is
yes,
the customer friction portion.
That's right.
So I think the other thing that we had kind of laid out to talk about was just like a lot of the tools are shifting in terms of financial wellness products. What emerging customer behaviors or needs are you starting to pay closer attention to as we're seeing a shift within products that are available?
Well, I think AI is certainly here in full effect. We were a beneficiary of getting into AI quite early, dating back to 2019. We were the first ones to really pair cash flow-based underwriting, of which we really tried to pave the way for better access to consumer credit by leveraging your transaction data to approve you for money. We're the first ones really to marry AI with that data set. And so that's really transformed our economics. It's transformed consumer access. We've been able to raise origination sizes per user more than triple over the last 7 years, and also seen our loss rates go from 25% per user down in the early days of Dave down to nearly 1%. And so I really liken a lot of that success to AI. It's just been a tremendous way for to democratize credit access, and ultimately fits squarely with the mission of leveling the financial playing field, because ultimately what you can do with AI, from customer support to financial insights, you really are giving a everyday consumer access to what were normally tools for wealthy, and that just fits squarely with what we're trying to do with the company. So excited for all the things that AI can do for us, what it's already done, and all the ways we can utilize it moving forward.
So maybe let's stick with AI for a second, even though that wasn't on my list of questions to expand on. But I think folks are understanding that you've been utilizing it for quite a while, and that it's the hot topic. Everyone's trying to navigate. The states have so many different laws that are coming out, and there's this real push to hopefully, have some unified approach to it. How are you guys approaching the regulatory overlay that's coming into play now? Is it, has it been an area of discussion with your bank partners, how the regulators are viewing you, and how have you really navigated that?
I'd say, at least on the underwriting side, not as much yet. I think right now it's hard to point at any instance where it's actually hurting a consumer. I mean, it's almost 99.9% helpful for increasing credit access for everyday Americans. And what it's really doing is trying to approve more people. It's not trying to approve less, and really trying to figure out what's the right amount of money to give to a customer, not how do we not give this customer money at all. So it's really more of a calibration we've seen within cash flow-based underwriting versus a excluder of, if anything, and it's expanding access to credit. And so from that perspective, haven't seen a lot of pushback or challenges from the banks on the utilization of it. I think the other component, which will become more under scrutiny, would be sort of the customer support element. Are customers getting the right answers to their questions? Is it accurate? Are there hallucinations going on? What kind of access are you giving the AI to help solve the problem? Is it going to have access to MNPI, all your bank level transaction data for customer support? I think it'll be an interesting growing area of opportunity and interest, I think, from banks and from regulators.
Yeah. So I think that's just an area, as we've heard in last panel here, and I think in every single industry working group that I'm on, no matter what segment we're dealing with, is that AI is the place where there's conversation, as well as just understanding of what it really means, because it's such a broad topic. So trust, right? So trust is obviously a very, very big part of your brand. How do you approach trust building in harder moments, right? So if you had a customer friction moment, if you had something that was impacting, how do you guys think of that? How do you navigate?
Well, I think it goes back just the founding story of the business. We don't have any late fees for our business. We have no compounding interest. Those two things alone really set us apart and help us build a lot of trust with our consumers. We also are very lenient and helpful for our members who come into financial hardship. If customers write in that need extensions or delays, we're obviously always willing to honor that, which is a great thing for our business. And because we have no late fees, it's not really a thing if you can't make your payment on time anyways. So that's first and foremost. The second is, at least myself, very readily available for customers. I get emails from customers that come under financial hardship. My email is not very difficult to find, and happy to answer those questions. And we love our customers, and so it starts really with that as the foundation for everything that we do.
In terms of, so by relying on other providers, relying on the banks, is there also somewhat of an element of ensuring that they understand who's doing what? How do you kind of approach giving a seamless experience, recognizing that you have vendors and you have folks that are supporting the overall process?
Yeah, I think there's a certain balance of what the customer sees and what they don't. We obviously have a customer sign their long terms and conditions agreements and everything like that, but first and foremost, customers want to make sure they're getting access to the features that you're marketing. and that those features live up to what you're offering. And so that's what we really focus on the most.
So this was the final prepared question, and then we'll, I think, actually be a little bit back on time. So
Yeah.
well, we did a good job there. What are the most practical steps you think that fintechs and their bank partners can take in the next year in order to expand access, but while strengthening accountability? So all the things we've been talking about.
I think it just comes back to, again, holding a high bar. I think the industry, for the near future at least, I mean, we need to hold a high bar for what it means to be a fintech partner and a fintech bank. And it's just, if we're going to be taken seriously and have a lot of durability within this industry, we need to make sure that folks know that there's just a lot of close knit partnership between the bank and the fintech, and that there's just a lot of accountability there. And so again, I think the best thing we can all do is hold the high bar.
Any other things that people should stop doing? Or, so we have a high bar in terms of things we should be kind of looking towards. There's also then, are there items that, we kind of see within the fintech space that are happening that we should think about kind of reining in?
Not so much reining in. I think if anything, just going back to the explosion of AI, I think there's just so much opportunity for companies to be leaning further in here. I think we're only scratching the surface of the opportunity of which we can all be taking a part in that, from, again, customer support, underwriting, KYC, approvals, fraud, just amazing ways we can really develop and push the envelope so that every American can have access to great financial services. And we think that's another great way that we're helping to lead the way here.
That's awesome. I appreciate all of your answers to all of my questions, even the ones that I didn't put on the piece of paper, so thank you for that.
Thanks, Katy.
And I feel embarrassed that I did also have to ask why it was Dave, and I think, David and Goliath is an amazing story, so thank you so much.
Yeah, thank you.
Thanks.
Thanks, everyone.